Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcast.
In fact, let's look at the there's another way to accomplish very similar objectives, and I have a specific example here. What we're looking at right now, EUU is the symbol. This is the index for the currency options on the euro-dollar exchange rate. So right now, for example, you could say that a pretty close approximation is that it costs $1.23 to buy a euro. So the index value right now is 123.45. And lately, as EUU has been trending down, as you can see here, since the beginning of the year, what that means is that the euro has been getting weaker. And in fact, even today, we pulled back quite a bit off of support, but even today we're seeing that weakness, and we're not getting a ton of news coming out of Europe, but it's only a matter of time. It's kind of like we're holding this ticking time bomb to a certain extent. When's the next round of bad news? When's the next? When is Spain going to have to rescue a big bank instead of a small bank? We've gotten some hints that there are some problems here in Europe that we're probably going to see a continued stream of this bad news. If we want to take advantage of that, well, in fact, not probably, but definitely the most common way for traders to take advantage of a move like that in the Forex market is with the euro-dollar pair. So you'll see that traded a lot more than just about any other currency. In fact, the euro-dollar. I know at times we've seen surveys that show that it's traded as much as everything else combined. So I think it's a little less than that right now, but it's definitely the most actively traded. So, and in fact, from a technical perspective, I think it would be useful. I'm going to pull up the actual spot chart for the Euro USD. So this is the actual spot chart for the exchange rate. And you can see here, it's $1.2343 for a euro. So the prices are the same. It's just moved over 2 decimal points. So right now it costs $1.23 to buy a euro. And if we scoot back here a little bit, you can get a sense for where we are exactly relative to some of the historical lows. So we haven't been in these levels for a while. And a break here of where we stopped the other day, so last week, could be a very nice opportunity to take a short position. But we run into that problem again of, we like limited risk. So assuming that you're looking to, diversify into, currency options to provide, exposure to another asset class, maybe a hedge against some of this uncertainty out there, and, maybe even profit from the problems in Europe. But we have this problem of, implied volatility being so inflated. So we could go in the money, which is the suggestion that I made when we were looking at the pound, or we could layer one option on top of another and turn it into a vertical, so turn it into a vertical spread. And there's typically, you hear traders talk about 2 kinds of vertical spreads, credits and debit. And in this case, I'm going to look at a debit spread as a for instance to make my point here with EUU. But we could make the same point with credit spreads. And the whole idea behind a vertical spread is, well, I should say one of the ideas behind a vertical spread is that you're going long an option, but then you're selling another option with the same expiration date but a different strike price. And what that does is it kind of eats up some of that time value. So you pay a premium and then you collect another premium. And in the case of a debit spread, which is what we're going to be talking about, we're going to look at a long put spread in this case, and we're going to compare it to just a long put position. And I think you'll see why we might evaluate that particular strategy in the market conditions that we see here today. So in the case of a debit spread, we're selling a premium that's a little less than the premium that we paid. So ultimately, we're still paying some money, but we're just paying a lot less to get into the trade than we would to buy just the long position alone and without the short leg component. So here's a for instance. Let's say, so right now we're at, I'm going to move my trend line here to 123.50. So we're at 123.50, and we could buy an at-the-money option at 123.50, so a put, okay? That right now, I priced it before the market closed, and it was, I'm kind of rounding some numbers here, but you'll get the point. So it was about $3 a share, quote unquote, or $300 a contract. So, which, if the market moves a lot, one of these real outlier events, it's moved a ton since the middle of April, so that there have been some, very, very significant profits available. So if it moves a lot, no problem. But we may want to consider what happens if it doesn't move a lot. So let's contrast this with another trade. Let's say that we were to create a vertical spread. And to do that, we're gonna buy a long put here at 125, and so that long put's going to cost us. It's a little bit in the money, so it's a little bit above the current underlying price, and so it's going to cost us about 380. So we'd be paying 380 for that particular position, but at the same time, with the same expiration, so all of these are expiring in July, we'll short a put at 120, so about $5 away. And that one's a little bit out of the money, so it's obviously paying less. And in fact, when I quoted it before the market closed, it was about 180. So we're paying 380 for the 125 put, and we're getting paid 180 for the short put down here at 120. So you net those out, and you have a position that is going to cost us $2. So down here we have a position that's worth $2. And with a vertical debit spread, our maximum profit is going to occur if the market closes through the spread, so underneath 120, so 120 or less. Let's imagine that it does, that the market closes at exactly 120 at expiration, and we wound up holding both of these two positions. So we're kind of contrasting this vertical here with just an outright long put position here, and the market closes at exactly 120. So that put is going to only be worth 50 cents because we had $3 of premium, $3 of that time value built up. And the market moved all the way down to 120, so it lost $3.50 worth of value, or thereabouts. So we now have a trade that's worth 50 cents. So in fact, even though the market went in our favor, it actually did drop. It dropped $3.50 and we're kind of assuming expiration prices here. We only made 50 cents because time value is melting away every single day, and by the time we get to expiration, it's gone. So whereas by contrast, if the market closes at 120, well, we have a put up here that's worth $5. We paid $2, and we have a put down here with a strike price of 120, which is worthless because we closed at 120. So we have a put that's worth $5 of intrinsic value. We paid $2, so we have a trade that's currently worth basically $3 of profit or 150% return. So versus a loss. It's really, and the assumption that we're making here is that because of market conditions, we're having amplified time value. Traders are nervous about the big unknowns that are likely to be lurking out there in the market. So it's ramped up these option prices. So rather than having to deal with a big entry price to get into an at-the-money option like this $3 option that I mentioned before, and then the market winding up not moving, we get a volatility crush where volatility comes down very fast, and that option starts losing value really fast as the volatility comes out of the market. In fact, I've even got an illustration here. I don't know, this is not a recommendation or anything, but I'm going to share another application with you for just a second that I think you might find interesting as a visual representation.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.